Chapter 18, we're going to talk about shareholders' equity and the different type of transactions that can impact those accounts. So this gives us a little diagram. So basically, the nature of our equity section is our owner's interest. Debt is obviously creditors, people who loan us money. Equity are people who invest in our company. And then think of our accounting equation. Our assets equal our liabilities and owner's equity, or flip-flop that, rearrange that formula. Assets minus liabilities give us our shareholders' equity. Or again, assets minus liabilities equals our net assets. So our net assets equal that shareholders' equity. But what accounts are specifically in there are our paid-in capital, our retained earnings, and then treasury stock. So again, in financial accounting, we would have talked about most of those, possibly not. You might not have gotten into treasury stock, but paid-in capital and retained earnings will cover more treasury stock in this course here. And then we'll also talk about other comprehensive income, which you would not have talked about in financial accounting. So here just shows you an example of the equity section of a balance sheet. So again, you could have a lot of different types of equity accounts, and each of those equity accounts are going to have their own paid-in capital. So it's always paid-in capital dash par. So we have preferred par, we have common par, preferred, oh no, that's common, sorry. We have preferred stock at par, we have common stock at par. Then we have some stock options, restricted stock. These share purchases or conversion of bonds, again, would kind of be unique things that could, like if we had bonds that could convert into shares of common stock. So again, kind of unique scenarios that can happen. Then here we have, again, where you're going to see the other comprehensive income. So you do kind of want to understand what goes into that other comprehensive income. So some of these we've talked about in our prior chapters, but now you're kind of seeing them all in there. So we have, if we have unrealized gain or losses on our investments, so if we're marking those investments up to market value and we have not sold them, those unrealized gains or losses don't go to our income statement. They go into this other comprehensive income section of our equity section. Net unrealized gains or losses on our pension assets, and then any deferred loss on derivatives, again, which would be an advanced kind of finance topic there. And then our paid-in capital, like you saw in that slide a couple ones back, you can have all different types of paid-in capital, again, depending on what type of equity you have. But the main one is when the shareholders purchase our common stock or our preferred stock, and they pay more than the par value, which is very, very common because normally the par value is very small. So they'll pay more than that to buy the shares of stock. That more than that part goes into our paid-in capital. And then our retained earnings is any net income that is left in the company that is retained by the company, goes into our retained earnings. And then treasury stock is when the company goes back and buys their shares of stock that are outstanding, but does not retire them. They can go back and buy them and retire them, which means they will never issue them again. But when they buy them and they hold them for some future purpose, that's what we're going to call treasury stock. So again, here gives you another summary of our other comprehensive income. So you do want to know that, what goes in there. So those net holding gains, so those unrealized gains, any gains or losses from our pension plans, deferred gains or losses on any financial derivatives, and then also this final one, adjustments from any foreign currency translation. So if we are buying and selling product and we're going between us and the European countries, there could be a difference between the US dollar and the euros between the time that we sell it and the time that we collect it. So that can change. And then we don't want to have a gain or loss that relates to our business when it really only relates to that foreign currency adjustment. So there are two components of our other comprehensive income. So there is the current component, what we have occurred during the current financial reporting period, and what has been accumulated over prior periods. So we will have those somewhat separated out so we know. Whoops. And then again, when we talk about corporations, they're publicly traded, and there's a lot of advantages to being a corporate company. The prime advantage is limited liability. So the owners, the stockholders who invest in that company are never going to be liable. The most that they could lose if something happens to that company, if they go bankrupt or they have a lawsuit, the most they can lose is the amount of money that they've invested in the stock. They can't, nobody can come after their personal assets. The ease of raising capital, again, if you're a public company, you can sell common stock, you could sell preferred stock, you could sell bonds, in addition to getting bank loans, which really all companies can do. The disadvantage is that it's definitely, there's a little more government restrictions in the reporting requirements. You've got to file with the Securities and Exchange Commission. You have to be audited, to have audited financial statements that are published through the Securities and Exchange Commission. And then another one is the double taxation. So the corporate company is going to fill out a 1120 to report their corporate net income, and they would pay income tax on that. And then when they pay, if they choose to pay dividends out to their shareholders, the shareholders have to report the dividends on their personal income, and then they too pay taxes on it. So the dividends are not tax deductible for the corporation. So the earnings are in a sense taxed twice, once at the corporate level and then once by the investors. So we've got not-for-profit corporations, so churches, hospitals, universities, charities, those types of things. There can be governmental corporations, and then of course there's publicly held companies. Those are probably our most common, but then there's some privately held companies. So like Aldi is a common example. I mean, we all have Aldis around us. They are a privately held company. Levi Strauss clothing line is privately held. So there's a few big companies that are around us that are privately held. And then like it says down there, so I mean, obviously sometimes privately held companies can then go public, or can go the other way. Like we have Shears Foods is local to me here in Ohio, and they were publicly traded and then they went private. So an investment group bought them out and took them private. And then those investment groups that take them private normally hold them for like 5 years until they grow to a certain level. And then they turn around and sell them again to make more money. So you could go back and forth that way again, depending on what is going on. Then limited liability companies, those are more and more common, but I feel like especially for smaller businesses, because it's kind of like a hybrid where it gives you the benefits of being a corporation in that you have limited liability, but the benefits of not having the double taxation. So you are just like a partnership or a sole proprietor LLC, single member LLC, and then those just run through your personal tax returns. So those are kind of becoming very popular by smaller businesses. So this is saying that if we have ownership already in our common stockholders, they have the right to vote on matters, just common stockholders, not preferred. They'll have the right to share in dividends if the corporation declares dividends. And then they'll have a right to the distribution of assets if the company then goes out of business. The preemptive right could also be offered where, say you have a stockholder who's a 10% owner in this company and they own 10% of the shares outstanding, and the company wants to issue out more shares. Well, they're going to give him first dibs, him or her first dibs to maintain their 10%. So they'll get the first right to buy the shares of stock to keep their ownership. And if it's like a family business like Walmart, I feel like the Walton family owns a large chunk of their shares outstanding, and they would probably want to keep that and not have it diluted. Preferred stock is an option. So all companies that are corporations have to have common stock. Again, either private or public. It's just a question of who owns that common stock. But the preferred stock is optional. It's another way for companies to raise money, but they don't have to do it. But if they choose to, those preferred shareholders are going to have preference over the common stockholders in both dividends and in distribution of assets. So if the company's declaring dividends, the preferred stockholders get theirs first. They may even get any ones that are in arrears, depending on how it's set up. And then if the company were to declare bankruptcy, the preferred stockholders are going to get their money before the common stockholders do. So then these are the different types, of preferred stock. So it could be cumulative or participating. So cumulative means if the dividends are in arrears, if they haven't paid dividends for say 2 or 3 years, whenever they do, they got to catch up on all those past due years for the preferred stockholders only. If it's non-cumulative, then they don't have to catch up. If it's participating dividends, then it's going to allow them to receive an additional amount over what's set forth in their contract. So then sometimes, like there could be a question to say if it's a mandatory, with preferred stock, if it's a mandatory redeemable, like that you have to let the company buy it back after 10 years or 5 years, that's really debt. So that was a way that companies were basically kind of issuing debt, but not showing it in the debt part of their balance sheet. So they'd call it mandatory preferred stock. That again, you had to redeem it. So obviously, then GAAP catches on to that to say, okay, if the company, if the investor's giving you money now and they have to be bought out at the end, that's really just like a debt or a bond. So then we're not going to let them call that equity. Par value, it can be assigned. Both our common stock and our preferred stock can have par values. They're normally just an arbitrary amount and normally very low. And the reason they're low, it depends on the state that they're incorporated in, but they have to maintain that. They can never pay that out in dividends. So they don't want it too high because, again, it just restricts their ability to use cash, again, in a worst case scenario. So then you want to know these journal entries. So again, hopefully this is a refresher to financial accounting for you. But if we sell these shares of stock, the cash is going to come in, and then so we'll debit that for how much we sell it for. We'll credit the common stock at par value, and then any remainder goes to paid-in capital. If we had no par value, the whole thing just goes to common stock because, again, we don't have anything to distinguish between it. We could also purchase assets and give them shares of stock instead of cash. Or we could have legal services, especially when we're first going public, we could choose to give the attorneys who help us shares of stock instead of cash, because again, they hope it's going to go up in the long run, making more money anyhow. So if we did, so say we issued out 1 million shares in exchange for a factory, and it's $1 par value, and the factory has a value. No, we don't know the factory's value. It was custom built, but we know the value of the stock. So it goes back to say, which is the better value? If you had the value of the factory, you could use that and then value the stock accordingly. But in this case, we do not have that price. So we're going to go with the price of the stock. So we're going to value that at $10 million, credit our common stock at the par value, and then the remainder goes to our paid-in capital. If we issue more than one security for one price, we're going to allocate it out between the different types that we're getting. So say we issued $4 million of common stock and then $2 million of preferred stock, and it was all at $10 a share. So we've got the money coming in. So $4 million, sorry, not the $10 a share, but $4 million total, for all of those shares. So we've got the 2 million shares of the preferred stock, and then 4 million shares of the I guess I think I'm oh sorry, I'm still reading that wrong. 4 million shares of common stock, 2 million shares of preferred stock, all for $100 million. Now I got it. So the cash comes in $100 million, and then we're going to split it. So obviously we know the par value that we're definitely going to put in there. Then the rest we're going to allocate. So in this case, we're allocating the 40 million to the the common stock, because that is the fair market value on the Wall Street Journal as of today. So that's a verifiable number. And then the rest is going to go to the paid-in capital the rest is going to go to the preferred stock, which is split between the par and the paid-in capital. Now then we can purchase those shares back. So sometimes companies will do that to distribute company profits to their stockholders so that they don't have to have that double taxation. You'd have to know that your stockholders want that, but you'd be buying back those shares, and they would be getting cash, but then they'd have a gain or a loss versus the dividends. So, I mean, again, you'd have to know that that's what's going to happen. There could be other times, though, you could do it because you want the shares of stock maybe to issue out stock options to your employees. Maybe you want to shift it so that maybe debt's cheaper and you're a little bit heavy in your stock outstanding, and you just want to pull some of those shares back. So there's a variety of reasons that companies can do that. So then what we call that, though, is either treasury stock. If we're just going to hold it for a short-term period of time, it'll be treasury stock. If we never want to reissue those shares, we can officially retire those. And then the shares, again, could be acquired for these different reasons. So maybe we want to do a stock dividend. Maybe we're eventually going to try to merge with another company. Maybe we can sense somebody's trying to increase their ownership in us and we're not okay with that. So we want to increase the shares that we have. So the treasury stock is going to go in and reduce our stockholders' equity. It's like a contra equity account. So it's going to be a debit to our treasury stock. And again, it's not going to be, we're going to hold them there until that we choose to reissue them or resell them. And when we purchase those treasury stock shares, we're going to record them at their cost. We don't go back to par value or anything. And then when we go to resell them, then we're going to sell them out at our cost, and then we may have a difference in what we sell them out for. And again, we might sell them at different times, which we'll have to look at how we value those. So here we've got a retirement. So the retirement means we're buying the shares back, but we're not holding them in our treasury. We're actually retiring them. We no longer want them outstanding. So when we retire them, cash comes in at the same amount, but we take them out of our shares outstanding and take them out of the paid-in capital. We're actually not. We're increasing our paid-in capital. So so in this case, though, that doesn't, no, I think I'm reading that wrong too. So they sold the million shares after reacquiring them. So they're not buying them back. So they sold them out. So again, the money's going to come in. We would reissue them out as existing shares if we had purchased them back as that. The treasury stock is the one that is going to be in there at our cost, the $13. That's what we paid for them. So then we're going to receive the cash, and then the amount that we receive over the treasury stock is going to go into paid-in capital dash share repurchase, because again, we're not going to record like a gain on selling our own shares of stock that we bought back. So we can't buy and sell our own shares and have a gain on it. And then this is again, if it goes the other way where we sell it for less. So we bought these shares at 13 and then we're selling them at 10. So again, notice the ones that were retired, it's just the same as issuing shares of stock to our par value and our paid in capital. When it's the treasury stock, the cash comes in. Now we can't have a loss, like I said, or a gain. So in this case, it's a loss because we sold it for less. So we got to take out what is in our paid in capital share repurchase account, but only up to the amount that's in there. We can't let that become a debit balance. It either has to be a credit or a zero. So in this case, we're zeroing it out, and then the remainder is going to go into retained earnings. Again, because we can't record a loss or a gain if it went the other way. Okay, then our retained earnings balance, if we have a credit, it means we had net income that we kept in the company and we did not give out to our shareholders in the form of dividends. If we would ever have a debit, it means we had a net loss. So that's not good. Now, if the company does have profit and it chooses to pay, they can pay out dividends and they're returning the share portion of the income to the shareholders. A liquidating dividend means that it is in excess of what we have in the retained earnings, and then it's going to be coming out of our paid in capital. And again, that wouldn't be a great scenario, but it does happen. We're going to sometimes have restrictions on when we can pay out retained earnings. Again, depending on our loans with banks and things like that, we may not be able to pay it out. And everything should always be disclosed in our financial statements so our users know. But in a regular scenario, we've got the earnings. We're gonna declare a dividend, and then it's gonna come out of our retained earnings and then create a dividend liability. There's normally a timing difference between when we declare the dividend and when we pay it. So we'll always have the board of directors will declare a dividend and they'll pay it on a specific date of record. So all the stockholders on that date would get the dividends. So then again, say it's a 14-day difference. Those shares could be bought and sold during that time frame. So then whoever the owner is on the date of record is who gets that dividend. So then again, there could be investors who've purchased it after that date, then they would not get it. So then our journal entries, again, here they are. So when the board of directors declares it, it comes out of our retained earnings, reduces our retained earnings, and we set up a payable. Then there's a dividend date, and then a date of record, and then there's a payment date. So notice there's probably about 2 weeks in between each of those. And then we're going to debit the dividends payable and credit cash. Dividends on the preferred stockholders, again, is going to go back to if they are cumulative or non-cumulative. So we calculate out what the preferred stock should get paid. So normally it's right in there. It's the percentage. So we have 6 million outstanding and it's paying 8% dividends. So then we would calculate that out to say, okay, we would owe them 480,000 if I'm doing that in my head. So then if the board of directors declare 360,000, all of that is going to get paid to the preferred stockholders, and there's still $120,000 in arrears, right? Then the next year, if they pay out the 500,000, again, it's all going to go to the preferred stockholders because they owe them 120 that's in arrears plus the 480 of the current year. So again, all of it's going to go. Then in the next year, if they pay the 780, then they're going to catch up on everything that's in arrears, which would be 100,000, and then pay them their 480,000 for the current year. Then what's remaining goes to the common stockholders. So you always got to figure out what do they owe them each year, and then kind of map out how much was paid and is there any excess to go to the common, and then kind of what carries forward. Whoops. The companies could also give out property so that you want to use the fair value of whatever that property is at the time. So like say it's an investment and you're going to give them shares of somebody else's stock, right? So you're going to first have to bring that investment that you have up to market value. So in this case, they have it on their books for 9 million. On the day that they choose to give it out, it's really 10 million. So they first have to record the gain on the investment. Then they can go ahead and pay it out as a property dividend payable. And then that would also get charged out of their retained earnings. Oops, sorry. So then again, on the date of record, there'd be no entry, but then on the payment date, again, instead of crediting cash, we credit the investment in the equities securities, because again, that's where it's coming out of. We're not giving out cash, we're giving those shares of stock. We could also, if we were short of cash, we could choose to give them stock dividends, or if we wanted to change the market price of our stock just a little bit, we could give out stock dividends. So it's just additional shares of stock to our existing stockholders. So this example, say it's a 10% stock dividend, and we have 10 million shares outstanding. We're going to issue 10% of 10 million. So that's going to be an additional 1 million shares that are going to be issued, and they have a $12 market value. So then that's going to be 120 million debiting our retained earnings, the 10 million coming out of our common stock, 1 million shares times the $10. So no. And then the remainder goes to paid in capital, but I feel like my 10 million is not right? If it's $1 par value and we're issuing a 10% common stock dividend, that'd be 1 million shares. So I'm a little bit off on where that 10 million is coming in versus just being 1 million. But that would still be the same. Let's see if they show me on there. 10 million shares at $1. But okay, I'm sorry. I'm going back to the top again. I'm reading it wrong. The 10% common stock dividend is not on 10 million shares. It is 10 million shares. So that's where that 10's coming from. And then the remainder goes to paid in capital. So what happens to the market value then when we do have stock dividends? Basically, if we're increasing our number of shares by 10% with no extra value, the market price goes down basically by 10%. So really on the day of that stock dividend, the stockholder receives nothing of value. It truly is just, okay, I have more shares now, but they're worth a little bit less. What happens is over time, if the stock price continues to go up, then you end up making money. So that is kind of how the market works. Now the company may do it for a variety of reasons. I mean, they maybe don't want to give up cash, but they want their shareholders to feel like they are getting some sort of a reward. And like I said, over time, if the stock price does go up, they do make money. But then they also may want to just capitalize that retained earnings, or they also may just want to bring the price down a little bit. Sometimes companies want to do that. Another way to bring the market price down is to do a stock split. And the reason they do that is to make their stock more marketable. If the price gets too high, then investors are a little bit turned off by that. So you want to keep your stock price. I worked at an oil and gas company, and they always wanted to keep the stock price around $25 a share. So if it went up to 50, they would do a 2-for-1 stock split to bring it back down to 25, because they just felt like it was a more marketable at that price. So then so companies can play around with that. And normally, again, a stock split is good in a growing company because it'll end up going up in time, over time, and then you'll end up making money. Whoops. But we want to know from an accounting standpoint, a large stock dividend is basically like a stock split. So if you had 100% stock dividend, it would really be a stock split. So they're really kind of trying to do the same thing. When we have a stock split, there's no journal entry. All that changes is our par value. So the dollar amount that's in the common stock account and the paid-in capital, none of that changes. It's just now, if we had a $100 par value, now we've got a $50 par value. So then that's really all that's going to impact it. So here again is the journal entry. If we do a 2-for-1 stock split, that's affected by 100% stock dividend when the market value is of the dollar par is $12 per share. So then we're just flip-flopping it between the common stock and the paid-in capital to bring that par value down. And then, or we could do it as a debit to retained earnings and then bring that par value down. But either way you look at it, nothing in your equity section of your balance sheet changes. It just moves between those two accounts. A reverse stock split's going to go the other way. So maybe your stock price goes so low and you want it to go back up. So you want to increase it. So then you have a 1-for-4 reverse stock split. So then where you had 4 shares, now you only have 1. So then that's going to, again, just bring that price up, because you don't want to have like the stock price selling at $1 a share, you know what I mean, or something very low. Okay, so that is our equity section and our variety of different equity